Hey everyone, welcome back to iLearn4x Learning Series Episode 3. We will be covering the steps to take the highest probability entry in this episode. You will learn how to qualify a good entry. Also, do continue to watch till the end. I have a free tool for you and you will love it. Okay, let's get on with today's topic, entries. Entry does not just mean entry only, and I do not mean sniper entry also. Entry means preparation, execution, and closure. So what are the steps involved for a trade entry? There are 4 main steps: setup conditions, entry trigger rules, stop rules, and exit strategy rules. Now the first step is setup conditions. What qualifies as setup conditions? It's basically the reason for trading when the setup is present. Conditions must be present in order for you to even consider a trade. For me, my preparation work before trading is to do markups on the chart for conditions to set up. These are key levels and trend lines. For key levels, there are actually different names such as zones, order block, or imbalance. To simplify, I would just call them key levels. For trend lines, this will add another condition for added confluence. If you're a trend following trader, for example, then you will need to determine trend. Your trading plan should define what a tradable trend is for your strategy. This will help you avoid trading when a trend isn't there. So if your reason for trading isn't present, don't trade. If your reason for trading, the setup is present, then proceed. So how do we draw key levels? For me, I would only draw levels on the time frame that I use for higher time frame confirmation. So therefore, in my case, it will be M30 as I take my entries on M5 with M30 confirmation. As price moves in waves, so when we draw our key levels, we focus on the lows and highs that are created and we try to join them. I have drawn the key levels here already so that it would not take up too much time. I would also draw 2 levels above and 2 levels below current price as I do not want to draw too many levels to clutter the chart. Now let's go through the 5 lines here. As you can see, the 2 levels above current price, I'm joining the current highs, okay, recent highs rather, with previous highs, okay, as you can see on the chart. The next higher key level is joining 2 highs as well, okay. The current price level where the key level is are basically joining previous lows with previous highs. Okay, the next 2 levels down is basically lows with the previous highs over here. Okay, and the very last line here is basically joining lows of previous price candles. As you can see here, the lows. Okay, so now back to current price chart. When you can see there are 2 rectangles here, when the previous trend is strong, it will leave imbalances that has to be filled at a later point in time. Those will inevitably become target areas. So now how do we identify where is the imbalance? Look where there are only buyers or only sellers in the market. So in this case, in a downtrend, the imbalance are created in the area where there are no buyers, and the reverse is true for an uptrend where there are no sellers. Okay, now let me explain a little bit more on this. Now on this candle, if you notice here, let me use the crosshair. This candle right here, you will notice there's a little tiny wick, okay? So it's a bearish candle with a wick that is created because there's a buyer that push it back up a little bit. And then going on to this candle itself, it's a very much bearish candle. So pushed all the way down here, and the buyers coming back up to here where the candle closes. And then following candle is a doji where price open and close at the same place. Okay, buyers pushing it up and sellers pushing it all the way down here. Okay, so buyers actually only reach up to this point, which means there is a void created between this week and this week. Okay, so basically in this candle space, there is no buyers, and therefore we call this an imbalance or a void. Okay, similarly for this candle, there is no sellers here, so there is this imbalance here. So you see, when this imbalance is created, price came back up to this to touch here. Okay, so that's why I said imbalances may be filled at a later point in time. As to when, nobody knows. Okay, so but it is a area where you can target take profit. So for example, if you buy here, you can target this imbalance for your take profit. Okay, now as for trend lines, I'm using an indicator that will automatically draw them for me. Notice this red downtrend, this downtrend. So the numbers here tell you how many touches. Okay, and one good thing about this trend line is when it's broken, it shows you as a broken trend line. So how do we confirm or know that a setup condition has been met? Basically, at the key level area, we would like to see price rejection or any confluence between the key levels and trend lines. So for instance here, price reaches this area and rejected downwards. So this is a good key level rejection, and we would want to look for other rules that we have in our strategy. That means a setup condition has been met. Once the setup condition appears, we would want to look for entry rules. Entry rules is also sometimes called trade triggers. What is a trade trigger? This will be specific to the strategy you use and the rules you follow. Trade triggers is basically means the confluence that your strategy requires. Once the setup conditions present itself, you will still require a precise event that tells you now is the time to enter the trade. Before a trade is taken, check to make sure the trade is worth taking. Is the reward worthy of the risk to be taken? A trade trigger should be one where you always know where your entry should be. There should not be ambiguity of maybe yes, maybe not. Good entry rules will not make you ponder or hesitate. In my strategy SK suite, I have 4 rules, which is number 1, box and master trend must be above or below or within outer bands. Master trend must have change color, showing a change in trend. Pearls must confirm with aqua crossing below the golden line in this case. The 4th rule is confluence with the higher time frame. If you are interested to know more about my strategy SK suite, please feel free to visit my website specialkforex.com. If you like the content that I have created, please click like on my video. If you have not subscribed, please do consider to subscribe. Having the right conditions for entry and knowing your trade trigger isn't enough to produce a good trade. The risk of the trade must be managed with a stop order. It is like a safety net to ensure that you do not lose more than you should. There are different ways to place a stop loss. Recent structure high or structure low, or you can use ATR stops, which is a certain distance from entry price based on volatility. Once you establish your stop loss, you can then calculate the position size for the trade. This is an example of where stop loss can be placed. Okay, so now that we have all the favorable conditions for a trade, as well as the entry point and stop loss, last but not least, we will have to consider the exit strategy rules. A trade can be exited either by stop loss or target profit. For a good trade, the profit target should be something measurable and not a randomly chosen target. It should also be a repeatable action, say bottom of a trend channel when you sell or top of channel when you buy. Establish your profit target based on the tendencies of the market you're trading. Trailing stop can also be used as an exit strategy for profitable trades. For trailing stops, you will not know profit potential. However, it will allow you to extract profits in a systematic way. Finally, we have covered all 4 steps, but let me say this, it may not be all for everyone. The execution of a trade may involve other steps for some. The 4 steps I've covered act as a filter so that you're only taking trades that align with your strategy, ensuring that these trades provide good profit potential relative to the risk. You can add in other steps to suit your trading style. For example, day traders may wish to avoid taking positions right before major economic news are released. In this case, to take a trade, check the economic calendar and make sure no such events are scheduled for while you're likely to be in the trade. Make sure conditions are suitable for trading a particular strategy. Set a trigger that tells you now is the time to act. Set a stop loss and target, and then determine if the reward outweighs the risk. If it does, take the trade. If it doesn't, look for a better opportunity. Always be patient. Consider other factors that may affect your trading and implement additional steps if required. This may all seem like a tedious process, yet once you know your strategy and get used to the steps, it should only take a few seconds to run through the entire list. Make sure each trade taken passes the steps test. It will be worth the while and the effort. So now, I promise to give a tool at the beginning of this video. So if you're interested to get the automatic trend line indicator, please feel free to leave me a message or a comment in this video. I will send the indicator to your email address. You can send an email to me also to specialkforex@gmail.com. Thank you. Hope you have enjoyed this video.